So you want to own an HVAC company. A genuinely essential service, since nobody skips fixing a broken furnace in January or a dead air conditioner in July, strong margins on service work, and a recurring maintenance contract model that can turn one-time customers into years of predictable revenue. It looks like one of the most durable trades a person can build a business around. Here's the number that should catch your attention before you assume this is just a steady local trade. Private equity add-on acquisitions in HVAC services rose 88% year-over-year through the middle of 2025, and financial buyers now account for roughly half of all HVAC company sales, up from about a third just a year earlier. In February 2026 alone, Blackstone paid $2.5 billion for a single HVAC platform company at a multiple of 18.5 times earnings. And yet, the single largest residential HVAC platform in the country, built through years of aggressive acquisition, still controls less than 1% of the total contractor market. This is simultaneously one of the most aggressively consolidating industries in America and one of the most fragmented, and understanding why explains almost everything about how to actually make money in it. By the end of this video, you'll know what it actually costs to start an HVAC business, why maintenance contracts are worth more to a buyer than they ever were to you, a brand new federal regulatory cost hitting every technician's truck right now in 2025 and 2026, and exactly how private equity turned a fragmented local trade into one of the hottest acquisition categories in the country. Owning an HVAC company isn't one business. It's three, all fixing the same furnaces and condensers. Version 1, the independent operator. A single truck or a small crew handling installs, repairs, and maintenance calls directly, with the owner keeping full control over pricing and the entire margin on every job. Version 2, the private equity-backed platform. A firm acquires a strong regional HVAC company as its foundation, then systematically acquires smaller operators around it, standardizing back-office functions and crew practices while scaling toward a much larger combined business. Version 3, the add-on acquisition. A smaller independent business gets acquired by an existing platform, keeping its local reputation and often its original branding, while its maintenance contracts, technicians, and territory get folded into the platform's larger, more efficient operation. Starting a lean, single-truck HVAC operation is genuinely one of the more accessible trade businesses to launch. A properly equipped service van or truck typically runs $30,000 to $80,000, new or used, and core tools and diagnostic equipment add another $15,000 to $50,000 on top. Layer on required state licensing and EPA refrigerant handling certification, general liability and vehicle insurance, and enough working capital to cover the slower shoulder seasons between heating and cooling demand, and a realistic lean startup budget commonly lands somewhere between $50,000 and $150,000, with a small multi-truck crew pushing well past that. Here's where the picture gets genuinely interesting. Not all HVAC revenue is created equal. Service and repair calls carry the strongest margins in the business, commonly 50 to 65% gross margin. Replacement and installation work runs somewhat lower, 45 to 55%, and new construction work, installing systems in brand new buildings, is typically the thinnest, 35 to 50%, since it's usually won on competitive bid. Maintenance agreements, the recurring contracts where a customer pays annually for a seasonal tune-up and priority service, can account for as much as 40% of a well-run shop's revenue, consistently delivering 35% or better gross margins. A typical independent contractor running the business without much dedicated back-office structure lands around a 10% EBITDA margin overall. A consolidated platform running the same underlying mix of work, but with centralized purchasing, standardized crew scheduling, and shared administrative overhead, can push that same business toward a 15 to 18% margin. That gap, roughly 5 to 8 percentage points, is worth an enormous amount of money once you multiply it across a large combined revenue base and it's the single biggest reason private equity has taken such an interest in this industry. Now for a hidden cost that's genuinely brand new, and every HVAC operator in the country, independent or platform-owned, is dealing with it in real time. Under a federal law called the AIM Act, the EPA has been phasing down the refrigerant that's been the residential air conditioning standard for over 2 decades, R410A, in favor of lower emission alternatives called A2L refrigerants. As of January 2025, manufacturers can no longer produce new residential systems using R410A at all. That transition carries real, unavoidable cost. Servicing the new A2L refrigerants requires new equipment on every truck, spark-proof recovery machines, specialized leak detectors, and left-hand thread fittings, commonly running $2,000 to $5,000 per vehicle. New systems built for A2L refrigerants cost 10 to 15% more than the equivalent R410A system they're replacing. And the price of the refrigerant itself has moved dramatically. One widely used A2L refrigerant has gone from around $345 a cylinder in 2021 to over $2,000 in 2025, driven by genuine supply shortages during the transition. Even R410A itself, still legal to use for servicing existing systems, has climbed from roughly $40 a pound in early 2024 to $50 to $90 a pound in 2026, with some markets and emergency calls pushing past $100. For a small independent operator, with 1 or 2 trucks, retooling for this transition is a real immediate capital expense that a larger platform can spread across dozens of vehicles far more easily. Here's the part of this industry almost no independent owner fully appreciates until they're approached by a buyer. The private equity playbook in HVAC follows a consistent pattern. A firm raises capital, acquires a strong, well-run regional company as its platform, typically financed with 30 to 40% equity and 60 to 70% debt, and then spends the next several years acquiring smaller operators around it, 5, 10, sometimes 15 on deals, folding each one's customer base and maintenance contracts into the growing platform. The economics work because scale genuinely lowers cost. Combining 10 independent companies under one administrative structure eliminates duplicate office staff, centralizes purchasing power with equipment suppliers, and standardizes technician scheduling and dispatch software across the whole portfolio. And maintenance agreements specifically become disproportionately more valuable once absorbed into a larger platform, because the recurring, predictable revenue they generate is exactly what public and institutional buyers pay the highest multiples for when the platform itself eventually gets sold or recapitalized. Recent deal activity makes the scale of this clear. One major HVAC platform sold a majority stake to a large asset manager in a deal worth roughly $1 billion in 2025. Another sold to a pair of global investment firms in December 2025. And in February 2026, Blackstone acquired a premium HVAC platform for $2.5 billion at 18.5 times earnings, a multiple that reflects just how much buyers are willing to pay for genuine scale and a mature maintenance contract base. Total HVAC-specific deal activity reached roughly 149 transactions by the end of 2025 alone. For a seller, a typical deal structure pays 65 to 80% of the purchase price in cash at closing, with the remaining 15 to 25% rolled over as equity in the platform, meaning the original owner typically stays on as an operator for another 3 to 5 years to help the new company hit its targets. The U.S. heating and air conditioning contracting industry generates approximately $159 billion in annual revenue, growing at a modest 2.5% to 3% a year. And despite years of aggressive consolidation, the largest single residential HVAC platform in the country still controls less than 1% of the total market. Tens of thousands of independent operators remain, which is exactly why private equity firms keep describing this sector as early to mid-stage in its consolidation cycle rather than anywhere close to finished. Scenario 1. An independent owner deliberately builds a maintenance agreement customer base from early on, pushing recurring seasonal contracts alongside one-time repair and installation work rather than treating them as an afterthought. When the A2L refrigerant transition arrives, this owner retools proactively in 2024 and 2025, absorbing the $2,000 to $5,000 per truck cost before competitors are scrambling amid supply shortages and spiking refrigerant prices. With 40% of revenue recurring and a genuinely modern equipment fleet, this business pushes its EBITDA margin toward the higher end of what an independent can realistically achieve, and when a regional platform eventually comes calling, negotiates from real strength, commanding a stronger multiple specifically because of the maintenance base and clean regulatory compliance the buyer actually wants. Scenario 2. An independent owner focuses almost entirely on reactive service calls and one-off installations, never systematically building a maintenance contract base, and delays the A2L retooling investment as long as possible to preserve short-term cash flow. By 2026, refrigerant costs have climbed sharply, and competitors who retooled early are capturing installation work this owner can no longer competitively bid on without absorbing a much higher cost per job. EBITDA margin stays stuck near the typical 10% independent average. When this business eventually gets acquired, it's valued primarily for its territory and technician headcount, rather than for a recurring revenue base or forward-looking equipment fleet, landing at a lower multiple than a comparably sized competitor with a real maintenance business and modern trucks. So the next time someone describes owning an HVAC company as a simple, dependable local trade, the dependable part is genuinely true. Furnaces and air conditioners break down regardless of the broader economy, but the actual value of the business increasingly isn't measured in how many service calls you can run in a day. It's measured in how much of your revenue is recurring, how current your equipment fleet is against a regulatory transition that's unfolding in real time, and whether a private equity buyer sees a fragmented local trade or a genuinely scalable platform when they look at your books. The furnace was never really the product. The maintenance contract, the retooled truck, and the multiple A buyer is willing to pay for both. That's the real economics of this business.